the West African market has seen bumper full-year earnings out of Stanbic IBTC amid the high interest rate environment and loan portfolio expansion. The lender's profit after tax grew by nearly 44%. On the downside, loan impairments surged as well as operating expenses, which could weigh on the bank's future profitability. Nabila Mohammed, banking sector analyst at Chapel Hill Denham, joins us with her take on the numbers and what it suggests for the outlook on Nigerian banks. Nabila, thanks so much for your time today. Now let's look at those numbers in greater detail, right? Profit up after tax up close to 44%. Of course, this boosted by net interest income as well as net fees and commission income. That just, showing top-line resilience, right?
Definitely, because if you remember or we recall, last year we did have a high interest rate environment in Nigeria, and the banks were able to benefit from that because we do not just make money from the loans that they give out, we also make money from trading activities that in the fixed income space. And we all know how interest rates moved from single digits at the end of 2023 to as high as double digits, 20%. In terms of real yield on the fixed income leg. So all these, the bank was able to rake in money from that. And as you rightly put it as well, fees and commission also played a huge part in terms of the top line performance, looking at it from a broad standpoint.
So looking at the group's loan book now, loans and advances to customers grew by 15.5%, but impairments soared. How concerned are you about that number in particular?
I mean, I am not surprised by the fact that impairments soared, and I'll tell you why. It's largely because we all know how the high interest rate environment could translate, or the high inflationary environment rather, can translate to negative impact on businesses generally speaking. So it is expected of the banks to take adequate provisions for every loan that is created in their books. And if it looks like there is going to be a further deterioration in loan book or in the loan asset as a whole, it will definitely translate to more provisioning. That is one. Secondly, we also have the fact that there was devaluation in 2024 in terms of currency. We moved from 900 at the end of 2023 to as high as 1,500 at the end of 2024. So that devaluation alone would mean that whatever FX-related loans that have been created in the books, when translating it to the local currency, it will balloon the number, or the number would look extremely big. And that would also mean the banks would have to take provision to cater to that excess value that it has translated to because of devaluation. So I wasn't surprised to see that impairment charges did so. And now if we're looking at in the long, like going forward, we do not expect that the harsh economic realities would remain the way they have been or the way we saw them in 2024. We are expecting to see more stability in FX this year. I mean, we've started to see it already. Currently, we're trading at around 1,400 sub 15 to the dollar in the FX market. And if that also is supported by other fundamentals in the economy, we'll see that these banks will not necessarily have to be taking additional impairments to address issues like that. So the outlook is looking bright from where I sit right now, except if something unexpectedly happens, which we do not really expect right now, like devaluation. We've had devaluation back-to-back 23 and 2024. We had another episode of it. So this year we're expecting stability that will also be supported by fundamentals improving, generally speaking.
So generally the outlook seems positive. But what do these numbers then suggest rather for the Nigerian consumer, the Nigerian business operating within this macroeconomic environment?
So, I mean, if we expect the major business of the bank is to provide financing to businesses. And they do that with caution because they do not want to aggressively grow their loan books by increasing the volumes of loans that they give out, especially in the current macroeconomic climate, which is understandable. So for businesses, these numbers, the high interest rates would deter them. And we've seen that happen because if we look at core loan growth for the banks in general, it was on average single digits versus what we used to see at 15% on average across banks. We had like sub 10% on average in terms of core loan growth. Now, if the interest rate environment is not as high, we definitely see more businesses walk up to the banks to, access credit to boost their business, either in terms of working capital or even capital expenditure kind of borrowing. But if that is not happening, because still up to now we still have high interest rate environment.
Yeah.
So until that comes down a bit, we'll definitely see more businesses emboldened to walk up to the bank to get credit facilities in order to do their own businesses. And again, on the other hand, the banks would be more prudent in terms of credit administration, just to make sure they do not give out loans that would eventually turn out to be bad, because that would have a ripple effect on their own earnings as well.
Talk to me about that a bit more, right? We are seeing expectations for the Central Bank of Nigeria to start lowering rates this year. Talk to me about the kind of impact that would have on the bank and the sector at large. I guess, are we going to see them opening the taps a bit more?
So for interest rate and what the monetary policy authorities will do, their decision is largely hinged on data. Yeah. And right now, the country is trying to rebase the CPI as well as GDP. But for the CPI, which is the core focus in terms of price stability, we'll definitely see them wait till this data is out and also see it, over the next couple of months. So in my own view, I not expect them to immediately start to lower interest rate, and it's largely because they would want to watch the trend, given the new series of data that would be released based on the rebasing process that's currently ongoing. So with that being said, interest rate environment will still be high, at least in the first half of 2025. And these banks will still be able to reap the benefit of that, either from their loan books or even from their trading books, that's from their fixed income instruments. So they will still enjoy that. Now, if that's even the case towards the end of the year, that's in H2 2025 now, we'll definitely see them open the tap more, as you mentioned. I mean, just try to increase on the volume of loans that they give out to support whatever shortfall that they may see if there is a lower interest rate environment. But I do not see that materially impacting their business, because these banks are also recapitalizing, and it will mean that they would have more money to lend out or to take out or carry on large ticket transactions. So when that happens, they wouldn't keep capital waiting and not deploy it to sectors of the economy, because let's not forget, the entire recapitalization process was largely because the country is targeting a $1 trillion economy, and they need these banks to play their role without any fear or without any squeeze on them as the financial sector. So once they have recapitalized, we have stronger banks, they'll have more money to create more credit to the economy. But again, certain things has to be considered, like being prudent in administering credit to businesses.
Nabila, from what you've been saying, it does sound like you are pretty bullish on the banking sector in Nigeria. Just walk us through your outlook.
So as I mentioned, to summarize my outlook for the banking sector, I would say this year we still expect that they would post strong earnings, and it's going to be supported by the high interest rate environment. It's also going to be supported by the fact that some of them have completed their capital raises, like Access, like Zenith. We've also seen some other announcements from the likes of FCMB, but they will still have to raise more, given that the type of license that they have. So what I'm trying to say in essence is that post recapitalization, these banks would have more money to lend out. And if the supporting macroeconomic indicators show that there is ease of doing business beginning to resurface in Nigeria, these banks will be emboldened to even create more loans. And we see loan growth, that's core loan growth now, improve from single digits that we've seen last year to around double digits. So that would also support their earnings. And with the valuations, from where I look at it right now, valuations are cheap, given the improvement in the books as well as the improvements that we have seen in the return on equities for this bank. So with that, all these all these factors, I believe that we'll still see some them post strong earnings. Now, the only downside that I see for now is the application of the windfall tax and how it would, play out in terms of earnings. And for now, there is no clarity really on how this will be applied on the banks that have fair value or FX-related gains, given the devaluation that happened. So when there is clarity, we'll be able to really tell which banks will suffer the most. But for now, there is no clarity, and that is the only downside risk that I see to this outlook of mine.
Nabila, thanks so much for joining us and just taking us through everything taking place in the Nigerian banking sector. That was Nabila Mohammed, banking sector analyst at Chapel Hill Denham.